Hey, good afternoon once again to all of our market rebels. Happy Thursday. And it's that time again for Coach's Corner.
Yeah.
Stu, thanks for being here,
Oh, you're welcome. Thanks for having me.
as always.
Very good.
And today, I kind of got this idea from you
Uh-oh.
because I know you get this question a lot, and I believe Scotty does too, from coaching. But when people like to sell calls, either as part of a covered call or a diagonal spread,
Yeah.
and they come up with really bad ideas about how they should I know you already know where I'm going with this, but how they should manage that and potentially roll or even select strikes. So I thought that'd be a good topic for today to share with our audience.
Yeah, let's do it.
All right, let's do it. So as always, let's start off with a little chalk talk question for anybody who's new, little thought challenging question here to think about. And then at the end of the presentation, if you haven't figured it out on your own through the presentation, we will come back and answer it. But for right now, you own shares at $100 and you sold the 110 call for 2.
Mm-hmm.
The question is, you should hold, or the statement, you should hold the call to expiration to collect the most money.
So, look, anybody that's been watching us for at least one or two times and knows me a little bit and knows you a little bit already knows what our answer is going to be,
Of course.
right? And has kind of figured out that, it's not always, and usually it's not as it appears. So
That is very true. But that's why we like to put out those challenge questions, because that's how people step into traps.
yeah,
Things are
absolutely.
rarely the way that they appear. So let's talk about our topic for today is tactics for selling out of the money options. Now, for this presentation, at least I believe I have it all in terms of calls, but it would also apply to puts.
Absolutely.
Why
And,
calls or
well,
puts, puts or calls?
while you describe the option as out of the money, as we're going through this, everyone, keep in mind that out of the money options can become at the money options,
Yes, I can.
and at the money options can become out of the money options.
Mm-hmm.
Right? We've
That's a
talked
good
about.
point. So just because you sell an at the money option doesn't mean it's always an at the money option. If it's an out of the money, now these concepts will apply. You have to
And
be aware of that.
it gets a little tricky sometimes because sometimes the stock moves a little bit, not as much as the full deviation, but it might move enough to kind of, border both sides of it, straddle the fence, so to say. Is it out of the money or is it money? Where is it on the curve? And it's a bit subjective at times, but just bear in mind that is very, as we've discussed before, it is very dynamic. Things change. The world changes. The stock moves. Strike prices stay the same. Stock moves up and down around the strike price. And what used to be your 30 delta out of the money call can very well be an at the money call. And now the characteristics of its state of decay have absolutely changed.
Absolutely changed. So that's what we're going to start off with is kind of the backstory on time decay and properties of options. And then we're going to see why that's important to understand and where the traps occur for people who use out of the money options. So let's start off with time decay. So I think everybody knows that option prices lose a portion of their value each day, something that was measured by theta. Everybody's familiar with that. But at the money options carry the largest extrinsic values, or the time values.
Mm-hmm.
And therefore, the at the money options decay the fastest. So because they, let's say for a given expiration, they all expire in, let's say, 30 days, but the at the money options have the furthest to fall because they have the most extrinsic value. So they have to decay at a faster rate. But as you move equally distant, out of the money strikes will have similar time values. Now, we also know because of the cost of carry, that's not exactly true, but in terms of the volatility value, it will be true. So let's take a look at a time decay graph. So these are from a pricing model. We're looking at 30 days to expiration, and I've made the $100 strike the at the monies. And you can see that here we've got different strikes across the bottom. And these are the option prices right here. So with 30 days, the at the money strike is going to be the highest. That's got the highest peak right there.
Highest dollar amount.
Highest dollar amount. Now, if we come out here to the left side, I'm charting out of the money puts and in the money calls. And on the right-hand side, we're doing out of the money calls and in the money puts. So this would be a high strike put. Stocks at 100, let's say the 115 call is out of the money, 115 put is in the money.
Now, I'm going to throw something out there right now. If you're watching this, anyone out there, if you're watching this and you're lost,
Good clue.
I would suggest that you call 1-800, let me get a coach. And
This is what the options trading is all about.
look, I'm not trying to promote myself here. I'm trying to get people to understand that there's things going on behind the scenes.
Lots.
And this terminology that Bill is using, it's just synthetic versions of one another.
That's right.
The fact that like you're at the money, you should know that it's going to be the most money. The fact that you're moving away from at the money means that the extrinsic value is going down in either direction. And there's all kinds of ramifications with that. Calendar spreads, diagonals. It just goes on and on.
Yep.
So it's all about the options theory, and that's it. So go ahead.
And we've kind of talked about that, where it's always about confidence. The at the money options, you have the least confidence as to whether they're going to be in or out of the money at expiration. But if you are, let's say, very deep in the money calls, you've got a tremendous amount of confidence that they will stay in the money. So yeah, they'll have a lot of intrinsic value, but they're going to have a very small extrinsic value because we're highly confident.
Yeah.
So why would I pay a lot for the right to walk away?
Here's a quick trap. And I get this a lot. At the money implied volatility 50. I'll just make a number up, 50. Way in the money, 85 delta, 90 delta call, which is the same as the out of the money 10 to 15 delta put. Volatility 80. And that person is afraid to buy the 80 implied volatility.
Yeah, we hear that a lot.
The 80. But in that kind of situation, that 80 means basically nothing.
Basically nothing, right?
There's no, depending on the time, the relative value of the extrinsic value is minimal. And
right.
The description of the extrinsic value by means of implied volatility, it's just an immaterial piece of information that could absolutely put you in the trap of, not buying it, go and buying the stock when really you should have been buying the option to replicate
right.
buying the stock, i.e. stock replacement. And now you just took on a whole piece of risk that you really didn't want to take and you didn't need to take because you didn't know how to read the volatility curve chart.
Right. So if we look at think of that word confidence, if you're highly confident that the option will stay in the money, it will have a small extrinsic value. If you're highly confident it will stay out of the money, it will also have a low extrinsic value because now you're saying, I'm pretty sure I'm going to be walking away from the deal. Why would I pay you for the right to walk away? I already know the outcome. So that's a way to intuitively understand why we get this upside down V where it starts to sell off this implied volatility or the volatility as we move away from at the money. Now, if we go to a longer dated option, same shape, just get shifted higher. There's 120 days. So if you look right here, at the money would have the highest time value. But as we move away, you can see that like right here, let's say for the 95 and the 105 calls, they're going to have, the 95 call and the 105 put are going to have about the same extrinsic values.
Yeah, yeah.
Or if you move out to here, maybe to the 85 and the 115s.
This is assumed no skew curve going.
No skew curves, right? Pricing model.
Very little, but basically, just to put it in English, look, if you have a stock and you got 100, if you have a 90 strike price put, and the stock or call either one, and the stock is like to the moon, well, what's that put going to be? Nothing, right? It's going down. It's going down in a hurry, right? We've all experienced it. And the call, which is going up in a hurry, is just gaining intrinsic value and it's losing extrinsic value. And that's what the representation of these lines here is in just different time frames. That's it, right? The same things are still happening. The put's going down, the call's going up. And we're just focusing on the time and the movement of the stock. Not really talking about days or volatility going by here.
Yep. So now, quick little blurb here for us. For anybody who's new, please check us out at marketrebellion.com/get started. We have a lot of great articles and videos to help you get started. It's really important that you get a good foundation because there's a lot of, believe it or not, bad information out there on the internet.
Yeah.
So now, question we want to answer, when does an at the money option begin losing money faster than average?
And that's that, and Bill's got that faster highlighted for a reason. Faster than
average.
It's a relative performance.
Yep. So here's what
faster than average.
Yep. Here is a time decay curve. Now, this is for at the money only. This is going to be important. Most people that hear about time decay graphs, whether it's in books or on a website, see this type of a shape.
Yeah, everybody.
And they assume that all options decay the same way. And this is, in a nutshell, this entire presentation to show you.
Wrong. Because everybody has to understand that there are different decay curves. Can they mesh together? Can, they kind of push around as the stock is moving up or down? Yeah. But you got to understand that there are different decay curves.
Yep.
Really important.
So here we've got days to expiration. And up here we have the value of the option. So let's say that I did this just to make the scales nice. We have 100 days to expiration. So at the halfway point, if we started with an option of 10, after 50 days, assuming the stock stays right there at the current, stays at the money, it's going to be trading for about 7.
Which it won't, but we're isolating.
Right, of course. Yeah, you're isolating everything. This is just the square root pricing rule in effect. But now the question is, what's the average decay?
Oh, that's kind of easy.
It's kind of easy. We got $10 divided by 100 days.
100 days. There you go.
So the average decay would be 10 cents per day.
Yeah.
Now, a lot of people who are brand new would certainly think that an option would decay in what's called a linear fashion. It would just be in a straight line. But that's not how they decay. You can see in the red curve, it's relatively flat compared to the average, and then it gets relatively steep compared to the average. So that tells us there has to be a point where they're equal. So take a look at this. If we look at a point in time and another, whether it's a day or two later, we'd see the decay rate for the blue line would be 10 cents. Why? That's always the number for the average decay. But the red line would be, let's say, 5 cents up here. It's decaying at half the rate of average.
Half the rate of average, yeah.
So if we come up to maybe towards the center, look at a couple of points in time very close, we might see that the blue, of course, would be 10 cents, but now it's starting to accelerate a little bit. Maybe it's 7 cents up here.
Not even average yet.
Not even average yet, right. But we are at least decreasing faster than where we started.
So here's a thing for everybody to think about as you're going through this. Think ahead, right? This is what I teach my clients. Think ahead, think ahead, think ahead. As Bill's doing this and he's going at, how can I say, like you're going kind of down in time, right? You're going out in time and the time is decreasing. Yep. Well, what's the next one going to look like before he does it? Just think about that. Stop the video and think about it. What's the next one going to look like? And what would these curves look like if it were not an at the money, if it were an out of the money, or even in the money? So go ahead.
So let's come up here to, let's say, 25 days. And if we did that, the blue curve would be, of course, 10 cents. But the red curve, look at that, would also be the same.
Wait a minute. You're telling me that they're going to be equal? The decay?
At a very, very small point in time, yes.
It's going to be equal to the average 3/4 of the way through?
We're going to talk about that. That's a good observation. Yep, it's going to take a long way for that to happen. And if we come out to this end of the curve, now our blue curve is going to be 10 cents, but the red might be 15 cents. Now it's decaying much faster than average. So the question that we started out asking, at what point does it decay? Is the decay rate equal to the average? And it turns out that one way we can visualize it, for all the people who know calculus, we can take this average decay and kind of slide it out this way. And right where they touch would be at the 25% mark. And so the way to visualize it, let's say these are snow ski mountain. We're looking at the side of a mountain. We have our red skier here and we have our blue skier. You can see that the blue skier is much faster, right? He's on a steeper slope. That's really all we're talking about when we mean this slope. So the option, the average rate of decay will be faster than the red. And that's what we saw. But as they move down this way, what happens? There's a point where they're equal. And then there's a point after where the blue is actually slower. You can see the red guy's going off a cliff here. So there is a point, and it turns out to be right when 25% of the time remains that you're going to lose 50%. And so look at that. We can see, because the average rate of decay when we hit this is going to be 10 cents per day.
And again, as usual, guys, look, guys and ladies, and I always do that. I'd never be gender specific, right? Traders, it's never going to be absolutely 25%. Sometimes it will be. It's in and around there. It's the general idea. It's the general idea. It's not half.
From a pricing model perspective, it is, though. It will come out because that's that square root pricing rule. And one of the ways we can show it is the square root of a quarter is a half.
But that's also, like, again, that's also assuming that everything is equal, which is, of course, never going to be in real life, which is where you get these variances from.
Of course.
Yeah.
But what we're saying is that if 25% of the time remains, half of the option's value remains. And so we can see it here. We started off at 10, we're at 5. Now, for at the money options, there's a couple other characteristics. The first 50% of the time, so we're going from 100 days to 50 days, you're going to lose 30% of that option's value. Again, assuming it's at the money. The next 25% of the time, so the next 25 days, you're going to lose 20%.
And that's your half that he just talked about.
And then if we go to the final 25% of the time, so inside this 25-day mark, you're going to lose another 25. So take a look. I'm sorry, the final 25% of the time, you're going to lose another 50.
Right.
So look at that.
Yeah.
Look at that. That's amazing. So if we add these first two together, the green and the yellow, that's 50%. So the first 75% of the time, you're going to lose half of the value. But in the last 25% of the time, you will also lose half your value. So it's this characteristic that makes a lot of people say, if you're selling an at the money option, especially wherever it is, we'd like to get within 50%. Because, I'm sorry, 25%, because you're going to decay absolutely as much as you did in the first 75%.
There's probably a bunch of people out there, Bill, that do credit spreads, right? Out of the money, put spreads out of the money. You can do iron condors, maybe even. Right. I will just look at that, iron condors. And, have any of you who've done that actually stopped to think about, well, if it's a 10-day outlook, middle of the week into the following week's expiration, if you got a 10-day outlook, why is it that like 4 days in, you can pick up more than half of them? You can pick up more than half. Oh,
yeah. That's the whole, that's right. The whole trade.
Why is that? You're ahead of that decay curve. That's the whole average thing, right? You're ahead of that. Right. And that's all right. I think I'm probably going way before I should be here. Right?
That's okay. I think we're going to be touching on that. So that's the main thing to see, is that for an at the money option, it pays to try to hold it as late as possible, right? We want to get into this window so that, if you've been holding it out here, maybe you worked, let's call it, really hard to go for the first 75 days or the first 75% of the time to collect half of that premium. You're going to do exactly the same amount of work in 1/3 that time.
But remember, you still have that very, very same obligation.
Yes.
And true. This is an at the money option. So you are still signed up to deliver the stock at the level at which it's trading. Right. For a dollar amount.
Yep. Okay. So anyway, keep this in mind. So this is where a lot of people make their mistakes, because they see this with the at the monies and they assume this is always how it works. We're going to find out that's not true. But first, again, quick reminder, marketrebellion.com/get started for some great tips and videos to help you with your options trading. So now let's turn the corner here and talk about time decay for out of the monies. Okay, as we said, it's going to be different, and that's what a lot of people fail to recognize. So let's put 100 days to expiration, 20% volatility, 1% interest. and I've got a 115 call priced at 50 cents. Now, if we put this, again, this is from a pricing model. So if we put this on a graph, look at that though.
And Bill, where's the stock on this?
I think the stock was 100. It's a 115 strike. It's just out of the money. But the point to see is that this curve is now pushed in. See, when we did the at the monies, it looked like this. And again, everybody assumes that time decay looks like this.
Yeah.
And they say, oh, you got to wait until you get into this range to start going off the cliff. That's for at the money. It is not for out of the money or for in the money. So let's take a look at how the numbers line up here. If we go to the halfway point, we saw that we would lose about 30%. That's why we got from 10 to 7 in that first example.
On the at the monies, everyone.
On the at the monies, right. But look at this down here, Stu. That thing went from up here down to here in 50 days. It lost 80% of its value.
Oh, hold on. I'm looking for my roll button. Where is it?
Exactly.
Right? Who's going to hold on to that option even at 50% of the time remaining when they've lost so much of the extrinsic value, right? The option did exactly what it was supposed to do. There's no money left.
There's no money left. And so what you would be better off doing is to close this one, or in the business we call it rolling, be a simultaneous trade where you would close this and sell a new one 100 days out.
Yeah.
And then you would buy it back with 50 days. So in both cases, you've held the option for 100 days.
Yeah.
And again, I'm just using that as for a reference point. So we have a nice scale of 100. But what most people would do is if they're holding here, look at how flat that red curve is. You're going to be waiting forever for no money.
Yeah. Here's another way to kind of say that, right? So halfway through, the number's down there, and you roll it and you do it again.
That's right.
At the end of the same 100 days, or let's go back. The first option, if you hold on to it, you're waiting to collect some amount of money. In this case, I think it's 10 cents, right? So if you're waiting to collect 10 cents and it's going to cost you X amount of days, I guess it's 50 days here. Well, what Bill's saying is sell another one and you'll actually collect more than
far more.
The 10 cents. And at the end of the whole thing, it's the same 100 days, but you've collected more money.
Right. Well, look at what we've done here. We've gone roughly from 50 cents to 10 cents. So we picked up 40 cents.
40
you
cents.
Double that, that's 80 cents, which is better than 50 cents had you waited.
Yeah.
Now, there's another problem here, too. Just the absolute dollar value.
There isn't any.
Exactly. We're so close to zero. You have to say, why would you? I mean, forgetting about whether you're in, at, or out of the money, it's only 10 cents. And yet we see a lot of people that will do this.
Yeah.
And say, let me continue to hold it so I can bleed out that last bit of theta.
Let me ride it to expiration. I want them to go out worthless so I can tell my buddies I wrote, a 9%.
Right. Soaked up 100%.
I mean, there's no money in it.
There's no money.
Here's a tip, everyone. Look at your position. Look at it today, not where it came from, but look at it today. Would you put it on? Would you hold?
Right.
Would you be sure?
Yeah, good test.
20-cent option today. Would you put it on?
No way.
I think most of the time you're going to say no.
Of course, you should.
You have it. It's the same thing. You have it. See, and if you decide to keep it, it's like putting it on today.
That's right.
So which is it? Make your mind up. Be the risk manager.
If you wouldn't put the trade on today for 10 cents, it doesn't make any sense to hold it for 10 cents. Why? Because you can close it.
Yeah.
And so, yeah, you can see that you would be better off to have closed it at the halfway point, and that's roughly where it will be for the out of the monies, and then resell it and write it twice. So that just becomes a huge, huge plus. But we see this a lot when people are doing, especially with covered calls. So, I mean, look at that. That's 80% of it in the first 50%.
Did we just give away like this giant, enormous tip?
It's a very good tip. If people, we find this all the time. Most people have never even heard of this.
This is unbelievable. There's so many ramifications to this.
Yep. So as a general rule, option sellers should consider closing out of the money options at the halfway point and writing a new option.
Yeah.
And you'll end up holding the position for the same amount of time.
Yep.
but you'll collect far more money. And as an added bonus, you'll also have better downside hedges.
Because you now have replenished the money that you
That's
took
right.
in with new money that is now higher. Come on.
Right. In that previous screen, if trader A holds 10 cents going forward, he has a 10-cent downside hedge. Doesn't matter where he sold it.
Doesn't matter.
Going forward is 10 cents that will hedge you. If you roll it, it's now replenished back up to 50 cents.
Yeah, there you go. Which one would you rather have?
What would you rather have? Yeah, better downside hedges, and you collect far more money. Now, you might think, hey, isn't that getting something for nothing? In a way it is, but the misperception is because you're misinterpreting the way the time decay graphs work. You're assuming it's an at the money option, and that's really where the fallacy is. It's not.
Let me mention this as well. Sometimes, in low vol stocks, you might have a position where you sold the option and it either became or is still an at the money option.
Yep.
And that dollar amount may still be very low. And you may still be looking at that at the money curve to collect all of that money on the last 25 or 20% of the curve, but there's no money, right? You got to keep that in mind. Even if it's an out of the money option where the curve is steepest, there still has to be money there to collect.
That's right.
A significant amount of money, which is kind of a subjective term, but then again, it's all relative to the movement. You have to remember that. You got to look at the dollar amount and you got to say, like, what am I doing? Is it worth having the obligation for this dollar amount? Even though I'm at the money and I'm on the steepest part of the curve. And many times the answer is going to be no.
And to add to that, sometimes people will say, well, I just sold it for 10 cents, so I should hold. Well, you shouldn't have even sold that option. Right. So forget about writing in. And that was a mistake back on the sale date.
That's just trying to justify a moronic thing.
Right. So anyway, we see all of that all the time in different angles. And so we thought we could at least share that with our group. But one of the things, because again, it does get tricky, it does depend. You might be slightly out of the money, and that doesn't mean you're going to lose 80% at the halfway point. So what's the best way to check? Check with your pricing models.
Yeah, just run through them.
Run through them, and you'll see where those points are.
Mm-hmm. Yeah.
So the main thing to take from this little takeaway, if you're not making the most of time decay, you're not making the most of your money. And if you're here to make the most of your money, these are some of the things you absolutely have to understand, and many of the things that we teach here at Market Rebellion. So if this is new to you or seems puzzling, give us a call. Check us out, marketrebellion.com. You can even sign up with Stu or Scotty. Hopefully we'll have Scotty on next week. Yeah. But anyway, these are some of the things that we try to help people with. So now, if you haven't figured it out,
that people, that they don't read about, they never heard about, there's somebody else who's talking about something that's completely wrong. Right? This is the real deal.
Absolutely. So if you haven't figured it out by now, here is our Chalk Talk question. You sold the 110 call. What's the clue there? It's out of the money for $2. You should hold the call to expiration to collect the most money. Now, of course, we have to assume all else equal, that it didn't fall to an at the money, but we're assuming that it's going to stay out of the money. So the answer here is absolutely false. You are, just by looking at that information, you're probably going to be better off closing it at the halfway point and rewriting it. So writing two of them at a half instead of one for the entire trip. But that catches people off guard. So hopefully it gives you some things to think about for any of you who like to do the covered calls or diagonal spreads.
Diagonal spreads. Yeah, this was great. This was absolutely a lot of information here. A ton of information. Usable information. Things that are just they get lost in the noise. People just it's not rocket science. It's not a secret. It's all there, but it's just things that people don't really think about.
Yeah.
And it doesn't allow them to be as good as a risk manager as they could be.
That's right. Too many times people find that they focus on what do you think the stock's going to do, but they're not focused on the strategic part of the trade.
Bill, ask me what I think NVIDIA is going to do tomorrow.
Yeah, what's NVIDIA going to do in the next, what's it going to do tomorrow?
No,
or
I have no, you know what?
or in the first 15 minutes of trading?
I have no idea.
We don't know, and that's not really even relevant. The question is,
Nothing to do with anything.
based on the information that we know today and based on the option prices, what is most likely going to be your best trade? You have to look at the expected values, not just trying to create a crystal ball. So those might be some good future coaches corner. Talk a little bit more
Expected
about.
value. Absolutely.
Yep. We've
Yep.
touched on those before, but we hope that gives everybody out there some good things to think about.
Yeah.
And we appreciate you being here, and we will look for you next Thursday, same time on Coach's Corner. We'll see you then.
See ya.